This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
This is the second of two lectures on capital asset pricing model. In the first lecture, I talked about what we meant by the business risk and the fact it was due to two separate factors, systematic risk and unsystematic. And without repeating the first lecture, obviously, we say that it's the systematic risk that determines the return shareholders require. That the more the systematic risk is, the higher the return they'll want, the lower the systematic risk, the lower the return. Well, systematic risk is measured for different types of business. And the measure is something called the beta. The beta measures the systematic risk. But the way it measures it relative to the stock exchange as a whole. The stock exchange, or we call it the market as a whole. Now think about this. I've already said systematic risk changes in the economy. So as, for example, exchange rates change, all businesses are affected, but some businesses are affected more than others. If they import-export a lot, their profits and therefore their share price will go up and down a lot. Other businesses aren't affected very much. Their profits and therefore their share price won't go up and down much, but they're all affected. The stock exchange, in all countries, they publish a stock exchange index, which is sort of the average of all the shares. And as the economy does well or the economy does badly, the stock exchange index, the average, goes up and down. There's risk. But because it's the average of all the shares, some shares are going up and down a lot more, some shares are going up and down hardly at all. The stock exchange is the average of them, and that's going up and down, but some are going up and down more, some are going up and down less. Well, as I say, beta measures the risk relative to the stock exchange as a whole. And so look what I've got there under paragraph 4. If something has a beta, if a share has a beta equal to 1, it's 1 times as risky as the market. The stock exchange as a whole, i.e. it's got the same risk as the market. On the other hand, if we find a share with a beta of more than 1, if it's got a beta of 2, it means it's 2 times as risky as the market as a whole. A beta of 3, it's 3 times as risky as the average of all the shares. So if it's more than 1, it's more risky than the market. The stock exchange as a whole. If it's got a beta of less than 1, if it's got a beta of 0.5, it means it's half as risky as the average, as the market as a whole. A beta of 0.8, it's 80% as risky as the average, as the market as a whole. If it's less than 1, it's less risky than the market. And finally, if we had something with a beta of 0, it's 0 times as risky as the market. Well, we say there is no risk, or the word is risk-free. Now, in fact, there are no investments which carry no risk at all. But the nearest to it, to something that carries no risk, are short-term government securities. Government securities, you can invest money in the state. You're effectively lending money to the state and they pay fixed interest. And we say, well, they're the nearest thing we've got to something that carries no risk at all. You're getting fixed interest, and the chances of the state going bankrupt can happen, but we say it's virtually zero. So beta, the way it measures risk, it's always relative to the market. Again, a beta of 2, we're twice as risky as the average. A beta of 0.5, we're half as risky. How betas are actually calculated is not in your syllabus. You'll be told what the beta is, but I will tell you later briefly how they calculate it. But they are published. You can look up on the internet for major companies what the beta is. However, I had said earlier, if we know how risky an investment is, the systematic risk measured by the beta, then we should be able to determine what return investors require. And there's a formula. Now, of course, proving the formula is completely outside your syllabus, but it's actually a terribly easy formula to apply. The way it's printed on the formula sheet makes it look far harder than it actually is. But in fact, when you've done a few of these, it becomes almost automatic. You don't really need to look at the formula sheet. If you look at paragraph 5, there is the formula. ERI equals RF plus BI, ERM minus RF. Blech. Let me illustrate how we use it with example 1, first of all. Example 1, Q has a beta of 1.5. So what does that mean? It means it's 1.5 times as risky as the market, the stock exchange as a whole. The market as a whole is giving a return of 12%. So the average return from the stock exchange today is 12%. The risk-free rate is 5%. And I said, although there are no investments that are 100% risk-free, we use government securities as an example. So we can get 5% from government securities. There's no risk. The market as a whole, there is a risk. And so the average return of the market is higher because of the extra risk if we invest in the market as a whole. The market is giving 7% more than risk-free. Or we say there's a market premium. 12 is against 5, 7%. The stock exchange as a whole does go up and down. There is a risk. And therefore the overall return from the market, understandably, is higher than when there's zero risk. It's 7% higher. But what about our investment, Q? The required return from Q, we know the risk-free rate is 5%. We want more than 5%. How much more depends on how risky this investment is. We know its beta, it's 1.5. So it's 1.5 times as risky as the market as a whole. For the risk in the market, we're getting 7% more than risk-free. For something 1.5 times as risky as the market, we want 1.5 times the 7%. The required return The market gave a premium of 7. We're 1.5 times as risky. We want 1.5 times the premium. So we want a premium of 10.5%. And therefore, shareholders in Q, they'll be requiring a return of 15.5%. All right, look at the formula. The required return is always the risk-free rate plus beta times what we call the market premium. ERM is the return from the market as against risk-free. But as I say, the formula makes it look far worse than it actually is. And again, when you've done it a few times, it's almost too obvious. You shouldn't be needing to look at the formula sheet. Look at example 2. R has a beta of 0.8. It's 0.8 as risky as the market. The market's giving a return of 16%. The risk-free is 8. So the market's giving 8% more than risk-free. What do we want from R? The required return. We want more than risk-free. Risk-free is 8. We want more. How much more? It depends on the riskiness. We 0.8 as risky as the market. And so we want 0.8 or 80% of whatever premium the market's giving. The market's giving 16 as against risk-free 8. It's giving 8% more than the market. We're less risky, more than risk-free, sorry. We're less risky, so we only want 6.4% more than the risk-free. The required return, 14.4%. Oh, look at example 3. This is a little work backwards, in that here we know what the return is, it's 20%. We know what the stock exchange as a whole is giving, 25, the return on government securities is 8%. And this time, instead of knowing the beta and wanting the required return, we know the required return, we want to calculate the beta. How can we do it? Well, the required return, remember, which here is 20%, it's equal to the risk-free rate, government securities 8%, plus beta, which we don't know, we're trying to find out, times whatever premium the market's giving. The market, stock exchange as a whole, is giving 25% as against risk-free 8. The market premium is 17. Well, now it's just a bit of easy algebra. Subtracting 8 from both sides, 12% is beta times 25 minus 8, 17%. Beta is 12 over 17, which is 0.71. We normally put betas to 2 decimal places, 0.71. So it's 71% as risky. We want 71% the market premium above risk-free. That's why they're wanting 20%. And in fact, although, as I said, you will never in paper F9 be expected to calculate betas except in that sort of way. Otherwise, you'd be given the beta. And the way they're calculated in real life is they do look over quite a long period at what return the market's been giving, what the return the share's been giving. And they do that sort of exercise. But instead of just looking on one day, they look at a whole, over several years, because things don't work perfectly. But they are effectively doing that work backwards. Okay, that's fine. What's the effect, though, on investment appraisal? Look at example 4, if you would. TPLC is all equity financed. They want to invest in a project with an estimated beta of 1.4, which is significantly different from the business risk characteristics of current operations. So however risky we currently are, we're going to invest in a new project, and we're told that the beta of the project is 1.4. We've got the cash flows, but we need to know what return do we need from this project. Well, the return we need will depend on the riskiness of the project. We know the riskiness of the project. It's 1.4 times as risky as the market. And so the return required from the project we'll use our capital asset pricing model formula. It'll be the risk-free rate of 6% plus beta, the riskiness, times the market premium. The market's giving 11 as against 6. There's a market premium of 5. And so for the level of risk in that project, what return is needed? 6 plus 1.4 times 5, 7. We need 13%. That's the return shareholders would want if they were investing in a share with that level of risk. We're raising money from shareholders, but we're investing their money in this project with that level of risk. And therefore, the return we need to get from this project is 13%. And how can we check? As usual, we discount at the return we need, 13%. What are the flows? Very simple project here. It's an outflow now of 100,000. It's giving returns of 15,000 a year in perpetuity. And to determine whether it's giving a high enough return or not, we'll discount at the required return of 13%. 100 is 100. The discount factor for a perpetuity, you'll remember, is 1 over R. And so the present value of the returns £115,385. The net present value, 15,385, we would accept. So if we're investing in a project with a higher or lower level of risk than we've currently got, well, it's the riskiness of the project that determines the return needed. And if we've got the riskiness of the project, it's beta. That determines the return we require. We require 13% for this project. Discount is normal at 13. This was trivial cash flows. It wouldn't matter how complicated the cash flows were. We've dealt with all that in the earlier chapters. But we discount at 13% because of the level of risk in the project. All right, well, I said proving that formula and everything is not in the syllabus. But there are two main limitations of capital asset, and there is 7.1. First of all, it's all right for example 4. I said the riskiness of a project was 1.4, but how on earth in real life are we going to calculate how risky a project is? In the next chapter, I'll tell you how we might go about it, but it's impossible really to estimate the riskiness of a project accurately. The other limitation is that Yet again, you're not required to prove it, but when capital asset was proved, it was really proved over just one period, 1 year, whereas the way we use it, well, the project there was lasting in perpetuity. We're obviously using it for projects lasting more than a year. So there we are. Now then, think about it. In this chapter, we looked purely at the business risk. We ignored gearing completely. In the previous chapter, we'd looked, not with any numbers, but we'd talked about the effect of gearing and what Modigliani and Miller said. In the next chapter, though, we're going to put the two together. For instance, this example 4. We were all equity financed, but suppose we did this project, but it was financed partly from debt, i.e. there's gearing. So we're going to put the two bits together, capital asset and Modigliani and Miller combined. And you'll see there's one more formula we're going to have to play with.